We're not just exposed to market risk, even if we've diversified away other components. No, there are other components of risk. And that's exactly what we're observing here. We're observing, based on these regression lines and how well our portfolios fit that particular market exposure, how much variation is going to be explained by this market factor. This is where it gets really cool, because we can see the market factor does not account for all of the variation in any of these portfolios. That is exactly what we see in our decomposition. If this is our market factor, that only accounts for 27% of the variation in this particular sample. What about the rest of it? That's going to be other components of priced risk that we haven't included in our model. This is where we can extend to Fama French 3-factor, 5-factor, and other components of alpha. This is where the academics will tell you if the market is perfectly efficient and we include all facets of price risk that investors expect return for exposure for, then we will perfectly explain the returns of our asset or portfolio. But of course, in practice, we don't actually observe that. There are inefficiencies. There is alpha, and that's going to be baked into the remaining variation beyond these different factors here that dominate the rest of the panel. That is exactly how I think about this CAPM model and other pricing models, other factor models in this particular context. You're effectively constructing a portfolio with different exposures. You can try to assess your skill as a manager in the context of timing or selection based on that alpha parameter. If you have some intercept that is statistically different from zero, then maybe yes, your ability to pick stocks has statistical significance. But broadly, in the context of portfolio construction, we are concerned with diversification across factors and an optimal construction that is going to mitigate to some extent this downside, even if we are riding primarily on market exposure. Now, what does this actually mean? Let's revisit the animation from earlier. Now we're going to look at our sector portfolios relative to the broader market, the S&P 500. If you were a portfolio manager and you selected the tech portfolio, then congratulations, you outperformed the S&P 500. You returned 87% for this holding period. The S&P 500 only returned 49%. But did you generate alpha? Absolutely not. Maybe you cite it as such for clients, but all you did was piggyback off of the market. Primarily, that tech portfolio was just an overexposure to the market return. In fact, during distress, you can see at its lowest, it even matches the lowest point of the market. That is what overexposure looks like. You can require a higher rate of return to recover from a lower rate of return. In other words, if the market drops 20% and you're overexposed, you are going to need way more than 20% to recover. And if you were that portfolio manager during this distress, you would have had to explain a almost a 45% drawdown to your client. I am uncertain of anybody who would want to stick with you after that one. So when it comes to portfolio construction, what do we notice? Well, consumer staples certainly didn't fall nearly as much as tech. And healthcare, yeah, it definitely underperformed, especially with that particular idiosyncratic component. However, we can see that relative to the market, it didn't fall as much. And we're observing this actually in the betas. So we can see that tech is overexposed to the market, but healthcare only has a quarter of that exposure. And staples, not far behind it, is roughly a third. So that means that during distress, even though the correlation structure is likely to increase, that is, everything will become increasingly correlated, tech is certainly worse off than staples, and staples is certainly worse off than healthcare. That is exactly what we see here. Our goal is then going to be to try to come up with an optimal allocation to take advantage of this market exposure to ride the upside similar to tech, but also match this flatness, this lack of exposure during distress. That is exactly what our objective is when we construct these portfolios based on different facets of priced risk. Now, market risk and market exposure isn't the only factor. We have other factors too. There's sentiment factors, which I've written about. My paper is available on SSRN. We have Fama French, we have Carhart, we have momentum, small minus big, we have high minus low. We have all of these different factors that we can choose for this construction and exposure. That's our goal when we go about applying these models in practice. So effectively, depending on your goals, you can construct a portfolio to bear the necessary risks in efforts to achieve that return. If you want crazy overexposure to the market, then sure, you can hold a primarily tech portfolio. But if you want a smoother return profile with a lower max drawdown, maybe you are going to combine more facets of staples and healthcare to reduce your overall market beta exposure, maybe overexposing or increasing exposure to other facets of priced risk. So in this particular context, the most important thing to take away is you are not trading an alpha if you outperform a benchmark. What this literally looks like is if we were to play this bear market simulation and we were holding this tech portfolio, we can see here the market did well. So our tech portfolio did well, even though we had this period of distress in the middle. If we had a bear market where the market was just in a slow bleed, we would be overexposed. That's exactly what it means to have a higher beta than 1. We're overexposed to that particular factor. But if we were trading an alpha and the market was in that bleed, then it really wouldn't matter at all for our strategy. That is the fundamental difference between alpha and beta. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, QuantGuild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long-run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.